Good morning, welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Monday, November 16th, 2009. It's 11:30 a.m. Eastern Standard Time in the United States. It's 4:30 p.m. in London, 12:30 p.m. in Bermuda. In Mexico City, it's 10:30 a.m. If you need to reach us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL instant mail address is CATEX-TV. We'll go right to our news. Guy Carpenter is saying that the storms that hammered the eastern part of the United States last week could cost insurers hundreds of millions of dollars. The reinsurance broking arm of Marsh Mac said the storm, a full-blown northeaster, was felt worse in Delaware, New Jersey, New York, North Carolina, Pennsylvania, and Virginia. At least 9 lives were lost because of the severe weather. And Carpenter said damage from the storm, quote, is expected to total hundreds of millions of dollars. Widespread flooding was felt at Virginia Beach and in Norfolk, Virginia. In our state of New Jersey, about 100 businesses were damaged by the storm, and both New Jersey, Delaware, and Virginia called states of emergencies for either the whole state or a number of counties. That report is available on the Carpenter website if you want to read it. Marsh Mac, speaking of the Carpenter family, has settled a class action suit on Friday afternoon after the markets closed. They agreed to pay $435 million to settle 2 of the largest remaining shareholder lawsuits triggered by the 2004 investigation into payments by insurance companies to brokers. Brian Dupereau, the CEO of Marsh Mac, said, "We're happy to put it behind us." Marsh agreed to pay $400 million to settle a securities suit and $35 million to settle another suit related to charges under the ERISA Act. Of the total, $230 million will be covered by insurance. The rest will come from cash on hand. Mr. Dupereau said that the settlement will have an impact on the company's fourth quarter results as well as a tax effect. The 2004 scandal uncovered by Elliot Spitzer, then the New York AG, started out as an examination of so-called contingent commissions. It evolved into a criminal investigation after evidence was uncovered of active bid rigging in order to steer customers to favored insurers. One data analyst has upgraded Marsh from stable to stable from deteriorating. She acknowledged that the broker court has finally put the contingent commission scandal behind it. Adding more good news to that, this man, New York Attorney General Mario Cuomo, late Friday asked a state judge to dismiss criminal charges against 2 former executives of Marsh. Mr. Cuomo asked the New York State Supreme Court Justice Yates to dismiss the indictments against former Marsh execs Tom Green and William McBurney, citing the potential cost in pursuing another lengthy trial following the acquittal of 3 former executives last month. The dismissal, if approved by Yates, would end the 4-year-old pursuit of allegations of improper bid rigging in the insurance industry. So this may finally be behind Marsh. Some bad news for SCOR today. An arbitration panel examining a World Trade Center indemnification dispute between SCOR and the German-based insurer Allianz has ruled that Allianz did not exceed its rights and obligations. In May of 2007, SCOR claimed that the $2 billion settlement between 7 insurers, including Allianz, and Larry Silverstein, the Trade Center lease owner, did not, quote, respect the terms and conditions of the certificate of reinsurance between SCOR and Allianz. SCOR claimed that the settlement contained an ex gratia element and exceeded contractual agreements. The panel decided that, in fact, this was not the case. SCOR has now said that it and its retrocessionaires, quote, will assume to the extent of their respective commitments their share in the indemnification obligations relating to the World Trade Center claim. The French reinsurer said that additional cost after tax relief and retrocessions would be about $58.5 million US. SCOR said that the additional costs were not likely to modify the dividend distribution policy or its financial position overall. Some good news from Amlin. They're saying that the first 10 months of the year have seen a 52% increase in premium, all the way up to about £1.3 billion. They've also seen low claims incidents. They've seen further runoff profits from reserves, and they've also seen strong investment performance. In the U.S. catastrophe reinsurance market, good rate increases have been achieved. Better rating conditions are anticipated in UK motor. The average renewal rate of increase for the group overall during the first 10 months of 2009 was 4.4%, with renewal retention stable at about 86%. CAT reinsurance, which represents about 28% of 2009 gross written premium, saw solid rate increases in the year and continues to offer good margin potential for Amlins in London and their Bermuda business. The P&C business saw an overall rate improvement of about 3.5% on the renewals. For U.S. property insurance, Amlin saw an average rate increase of about 6.6%. U.S. casualty experienced a decrease of 1.7%. Charles Phillips, pictured here, Amlin's CEO, said, quote, "We have had an outstanding quarter's performance and expect the full-year result to be an excellent one. Moreover, the group is well positioned for a 2010, in particular, improving condition situation for our UK business becoming more valuable and visible." The insurance investment vehicle Randall & Quilter has revealed the identity of the U.S. insurer it acquired earlier this year after the transaction has now received regulatory approval. Randall & Quilter CEO Ken Randall said that the company has closed its purchase of a 70% stake in Gold Street, a small U.S. reinsurer that's been in runoff since 1987. They purchased the stake from Gold Street's parent, Sequel Corporation. Randall & Quilter paid about $3.4 million U.S. in cash for the stake, a discount to the group's $9 million net asset value. Randall & Quilter said it's in negotiations to acquire the remaining equity. Randall himself said, "We're pleased to have successfully concluded the acquisition of Gold Street, which serves to increase our presence in the U.S., where we now have 3 group-owned insurance companies." The U.S. stock market is surging. It's up about 125 points now. We'll go to a word from our sponsors.
Every day, the world wakes up and goes to work, pursuing the unique opportunities that lead the global economy forward. The complexity and close connectivity of today's global marketplace is a true modern miracle that can create unparalleled success. But it takes confidence, passion, innovation, and understanding.
Enabling opportunity.
Protecting capital.
Engineering innovation.
Investing in your future.
Ensuring continuity.
Finding the right balance.
It takes Aon.
General Motors out of Detroit said that it generated $3.3 billion in cash in the third quarter, and it now plans to start repaying government loans early. The biggest U.S. car maker said this morning that it lost $1.15 billion after its July 10th exit from a restructured situation engineered by the Obama administration. Cash on hand as of this morning totaled about $42.5 billion at the end of the quarter. And GM also reported progress in cutting jobs and shutting down dealerships. People have been waiting for these results. They provide the first glimpse of GM's financial performance since coming out of bankruptcy. The chairman of the company, Ed Whiteacre, and CEO Fritz Henderson said that the numbers are encouraging. Some of the analysts are saying that the new numbers demonstrate that the government gave GM a reorganized balance sheet and it's made them more competitive. GM reported unaudited data for July 1 through July 9 for the pre-bankruptcy period and for the period since July 10th. Revenue was $28 billion for the full 3 months. Henderson said, "We're ahead of the bankruptcy plan, not